What's up, everyone? I just read this entire thing. It took me like 30 minutes, so I'm just going to do this again, but I'm going to go briefly this time. If you want to pause the video and read it yourself, you're more than welcome to do that. Basically, what I'm going to do is go over the Federal Reserve's tools for control and the tools and resources they had because of COVID-19. Let's take a look. So the discount window from the Fed. It's a traditional tool, and it's lender of last resort function for banks. Healthy banks can borrow on demand from the discount window by pledging their assets as collateral, which minimizes risk to the Fed. So hear me out. Our strategy, why it works, that is exactly what we're exploiting. The fact that healthy banks can borrow on demand from the discount window by pledging their assets as collateral. We all know that in this situation, who are the healthy banks? The biggest players. In a March 15, 2020 announcement, the Fed encouraged banks to borrow from the Fed's discount window. The Fed encouraged banks to borrow from the Fed's discount window to meet their liquidity needs. The Fed lengthened the maturity of discount window loans to up to 90 days. It also reduced the discount rate to the top of the Fed's target for the federal funds rate, so that the discount rate is no longer significantly higher than the market rates. Typically, the discount rate is kept above the federal funds rate. Discount window lending is negligible in normal conditions, but surged in March due to the pandemic. The Fed also encouraged banks to use intraday credit or daylight overdrafts available through the Fed's payment systems as a source of liquidity. Banks use intraday credit from the Fed when their reserve balances are not large enough to cover lags in the settlement of payments. The Fed typically limits the use of intraday credit because it exposes the Fed to credit risk if a borrower defaults. Now, they established a ton of emergency facilities in response to COVID-19. They created, the first wave was programs announced in March in an attempt to stabilize over financial market conditions, which experienced illiquidity at the onset of the pandemic. The facilities became operational between March 20th and April 14th, and their usage fell off quickly in the late spring. These facilities were focused on shorter-term credit markets. Later programs were focused on longer-term credit markets, including consumer credit, corporate and municipal bonds, and loans for businesses that were harmed by the economic disruption caused by COVID-19. So the COVID-19 is the culprit for all of these tools. Now, these programs are set up in different ways. In some, the Fed purchases loans or securities. In others, the Fed makes loans directly to affected entities. And in others, the Fed makes loans to or purchases loans from financial institutions or investors so that they will intervene in affected markets. These loans are typically made on an attractive term to incentivize activity, including by shifting the credit risk to the Fed by making the loans on a non-recourse basis. Now, non-recourse is very important. What does that mean? Recourse requires the borrower to repay even if the value of collateral falls below the value of the debt. So a non-recourse basis would mean that non-recourse does not require the borrower to repay even if the value of the collateral falls below the value of the debt. So, cheat codes. So these are two facilities here, the PMCCF and the SMCCF. Basically, in response to reduced liquidity, the Fed created two new facilities, the PMCCF and the SMCCF. The PMCCF, which purchased newly issued corporate debt, and the SMCCF, which purchased corporate debt exchange traded funds, or ETFs, on secondary markets or the market where you and I trade. The issuer must have material operation in the U.S. and cannot receive direct financial assistance from any other Fed programs related to COVID-19. Next, we have the TALF, the Term Asset-Backed Securities Loan Facility. In response to a 70% decline in the issuance of private asset-backed securities between Feb and April 2020, the TALF made non-recourse 3-year loans to private investors to purchase newly issued, highly rated asset-backed securities backed by various types of loans other than residential mortgages. Eligible ABS included those backed by certain auto loans, student loans, credit card receivables, equipment loans, floor plan loans, insurance premium finance loans, small business loans guaranteed by the SBA, commercial real estate, leveraged loans, or servicing advanced receivables. Next, we have the MSLP, or the Main Street Lending Program. This bought new or expanded loans from depository institutions that are 5-year loans to businesses and nonprofits with up to 15,000 employees or up to $5 billion in revenues. It was composed of 5 facilities, depending on the type of loan and borrower. The loans must defer principal for 2 years and interest repayment for 1 year. The borrowers have to make a reasonable effort to retain employees. So, thus, the program was targeted specifically to lend to businesses that had temporary disruptions to revenues. If you want to read this, go ahead and pause it. Basically, the facility purchased only debt issued in anticipation of taxes or dedicated revenues of states, District of Columbia, larger counties with at least 500,000 residents, and larger cities with at least 250,000 residents. However, states without at least 2 counties and cities that met the minimum population could designate any combination of their 2 largest cities or counties to participate. Now, 2 of these programs are backed by non-CARES Act funds from the ESF. And these are going to be, number 1, the MMLF, or the MILF, the Money Market Fund Liquidity Facility, which makes non-recourse loans to financial institutions to purchase assets that money market funds are selling to meet redemptions. This reduces the profitability of runs on monies, or the probability of runs on money market funds caused by funds' inability to liquidate assets. The Fed was concerned that unusually large redemptions by fund holders in March 2020 could spiral into a run. So these people are worried. So what do? Implement all the tools they need to make sure they don't have to fucking pay for any of their obligations. By the way, all these facilities that I'm reading now, these non-backed ESF ones, were extended till, guess what? March 31st, 2021. Now, the commercial paper funding facility is short-term debt issued by financial firms, including banks, non-financial firms, municipalities, and asset-backed pass-through entities that purchase loans. Money market funds are a large purchaser of commercial paper and had cut back on their purchases when they faced large redemptions in March 2020. The CPFF gave issuers an alternative buyer, basically. That one was also extended. 2 other emergency programs are not backed by the ESF. We have the Primary Dealer Credit Facility. Basically provides liquidity to primary dealers, who are a group of large government securities dealers that are market makers in securities markets and are the Fed's traditional counterparties for open market operations, or the different types of operations that I'm describing to you right now. Like banks, primary dealers are heavily reliant on short-term lending markets in their role as securities market makers. Unlike banks, they cannot access the discount window. Like the discount window, the PDCF provides fully collateralized loans to primary dealers for up to 90 days at the discount rate. And guess what? This one was also extended and is currently scheduled to expire at the end of March 2021 when the repo demand took over. We also have the Paycheck Protection Program lending facility. If you were employed during COVID, you probably have heard of this. The PPP provides low-cost loans to small businesses to pay employees. Although this facility was not backed by ESF funding, these loans do not pose credit risk to the Fed because they are guaranteed by the SBA. The facility was extended and is currently scheduled to expire, you guessed it, at the end of March 2021. So you see the going trend here. COVID came in, everything was going to shit. March 2020, they implemented all these programs to save the day, and then they all expired March 2021 when the repo demand then took over. Now, this is how the Fed Reserve's balance sheet is affected by all of these facilities. If you'd like to pause this and read it, go right ahead. In a nutshell, the Fed finances its emergency facilities, securities purchases, repurchase agreements, and other COVID-19 responses by expanding its balance sheet. That's how it does it. It expands its balance sheet, and it basically says right here that there is virtually no constraint on how much the Fed can expand its balance sheet other than its general mandated goal of maintaining price stability. So, you go get them. Here's a very nice table that actually shows you the differences between all these different facilities. I'm just going to read down the what is the Fed doing column in these for each one. So at the discount window, the Fed's making loans. At the commercial paper funding facility, the Fed's purchasing securities. At the primary dealer credit facility, the Fed's making loans. At the money market mutual fund liquidity facility, the Fed's making non-recourse loans. The primary market corporate credit facility, they're purchasing securities. And at the secondary market corporate credit facility, they're purchasing ETFs and syndicated loans. Term asset-backed securities loan facility, the Fed's making non-recourse loans. And the Paycheck Protection Program lending facility, the Fed is again making non-recourse loans. At the Main Street Lending Program facility, what's the Fed doing there? They're purchasing loans. At the Municipality Liquidity Facility, they're purchasing securities. So all of those people that have been telling me that I'm wrong about how the Fed monetary policy works, they're doing all of it. They're making loans, they're purchasing securities. They're making loans, they're making non-recourse loans. They're purchasing securities, ETFs, and syndicated loans, making non-recourse loans, and purchasing loans. So, yeah. Badass. Let's go, Brandon. That's not political. I just think it's funny. Okay? Relax. It's going to be fine. We're all doing it. Live it up And we're going to it. I'm retarded.